Hi everyone, welcome again to RHB Asset Management Podcast Series. I'm Fauzi, Chief Investment Officer, Equity Malaysia. We have seen the global equity market rebounded strongly after massive fiscal measures and liquidity injection by central banks. International Monetary Fund estimated that countries globally have spent about US 8 trillion on fiscal measures and liquidity injection by central banks amounting to over 6 trillion US dollar to revive the economy. The index is behaving as if the world's economy will rebound sharply and the economy will avoid deep recession. It is a bit strange why US equities perform better than Asia, as COVID-19 situation in Asia is better than US and advanced economies are expected to contract more than emerging market and developing economies. European economies are expected to perform the worst in 2020. World Trade Organization forecasts a fall in global trade of up to a third, which will be compounded by unavoidable declines in trade and output. Going forward, trade prospects look challenging with disruption in production, employment, business activities of major trading partners associated with fast widespread of COVID-19. IMF is also predicting global GDP to go into recession. The first global recession since 1980, the impact of the COVID-19 pandemic is more severe than Asia financial crisis in 1997 and 1998 and global financial crisis in 2008 and 2009. The lockdown, which was imposed by many countries globally as measures to contain the pandemic, has disrupted not only global supply chains but also affected the demand on commodities. Commodity prices, for example oil, natural gas and metals, have come down sharply due to the weak demand. This will have an implication on Malaysia's revenue as Malaysia is a major exporter of oil. The oil market is expected to face with the largest demand destructions since the Great Depression. The IMF is predicting global GDP likely to fall by 3% in 2020, and Bernstein Research expect global oil demand to fall by over 9% or 9.2 million barrels per day in 2020. Bernstein Research is also expecting second Q 2020 demand likely to be 20% lower than year on year. While OPEC Plus have cut production, it is too little and too late. Based on the latest supply and demand estimates, Bernstein Research expect that the market may be oversupplied by 13 million barrels per day in second quarter 2020. This equates to around 1,200 million barrels per day of crude that needs to be stored, or around 100 million barrels per week. Hence, oil price is expected to fall further in the short term. This will have a negative impact on Malaysian economy and the government's revenue. Oil and gas mining and refining activities contributes about 9.3% to Malaysian economy in 2019. The percentage of contributions has been declining from 11% in 2015, but it remains significant. Malaysia real GDP growth slowed from 6% in 2014 to 5.1% in 2015 and subsequently to 4.4% in 2016 when oil price collapsed in late 2014. Malaysia GDP will be affected if oil price remains at depressed level until the end of 2020, and it is estimated that every USD $10 per barrel drop in crude oil price will translate into 0.1 to 0.2% percentage point falls in GDP. In addition, the government revenue will be affected as well since oil-related revenue contributed about 19% in 2019. Besides weak oil price, Malaysia will also be facing with weak palm oil price due to weak demand. Palm oil contributes significantly to the agriculture sector in Malaysia. In 2018, palm oil contributed around 37.7 billion ringgit or 38% to the agriculture sector GDP and 2.8% to the total GDP of Malaysia. The fall in the oil price and demand for palm oil products due to the COVID-19 pandemic will also have a negative impact on government revenue and GDP in 2020. Hence, we are expecting the negative developments would have an impact on corporate earnings in Malaysia and FBM KLCI performance. FBM KLCI performed in line with other markets in the world. The index was up 15% from its lower level of 1,219 recently. During GFC, FBM KLCI index consolidated for 6 months after it rebounded from the low of 800 points. The index rebounded by 17% from its low before the consolidation took place. If history is any guide, the speed of the rebound in global equities is more consistent with a bear market rally than the beginning of a new bull market. Typically, for a new durable bull market to emerge after a vicious bear market, a consolidation period or a base building phase is needed. As of now, share prices have not formed such a base. In terms of strategy, we will keep holding cash higher than normal market conditions and will trade the index. We know that markets will come back from every correction and eventually make new highs. The current correction in the markets provide investors a huge opportunity to increase allocation to equities with a medium to long-term view. Thank you.